The U.S. is no longer the world's most competitive economy. According to the World Economic Forum, Switzerland is now #1. The European country was credited for its stability and innovation. The U.S. lost marks for its rising budget deficits, along with its shaky banking system. Singapore, Sweden, and Denmark rounded out the top 5. China climbed 1 spot to 29th, while Russia fell 12 places to 63rd. Largely on concern of the government's growing role in its economy. Well, if you too are a little shaky about the prospects for the U.S. economy, where then should you invest? Metzler, Payden's Vlad Milev is betting on Eastern Europe, particularly Russia and Poland. He joins us now from Los Angeles. Welcome.
It's good to be here, Lauren.
So we just heard about some of Russia's economic problems. What attracts you then to Eastern Europe?
Well, I think that in the case of Russia, there should be no surprise that there are issues on the corporate governance and the political side. So we'll think by now the market has fully discounted those and you get paid for that risk. But generally in emerging markets and emerging Europe in particular, we think that based on a better than expected global recovery and valuations that seem still pretty attractive, we think that you can probably make some decent performance in the next coming years.
If you do have concerns about the future of the U.S. economy, is it really the right strategy for an average investor to hedge with bets on emerging markets?
Well, there's two sides of that question. First of all is the equity performance side. And if you look at how well Russia's done since the beginning of the year, for example, a lot of that rally was based on China and the Chinese commodity story and Chinese growth, not necessarily the U.S. recovery. So we might be getting into kind of a next phase of the global economy where other countries, not just the U.S., actually lead us out of a recession, just like China has been doing. The other side is the currency side. If you're worried about a weak U.S. economy and a weak dollar, as a consequence, having foreign exposure through equity will give you a nice extra kick from that foreign currency exposure as well.
Are you concerned about higher commodity prices? Crude is back above $70 a barrel.
Well, compared to last year, though, we're down about from 100 to 70. So it's all, I guess, the frame of comparison, the base of comparison. In the case of Russia, we love oil prices. The fact that oil is at the 68 this morning, 70 handle, it means that the Russian budget's going to do well. It means that the Russians are going to have money to spend again. It means the economic growth will probably be in the 4 to 5% next year. That's good news for us.
So then are there interest rate differentials to take advantage of?
Interest rates have actually come down in a lot of those Eastern European countries as inflation has come down as well. So I wouldn't necessarily go that route. I think the equity route gives you a lot more opportunity at this stage.
All right. So Russia, we've been talking a lot about Russia. As of July, your portfolio was 40% invested in Russia. First question, are you still positioned with that percentage? And what are some other countries?
It's actually been reduced slightly since then. Normally we have about a third of our portfolio in Russia. It went up to as high as almost 60 early in the year as we were betting on this Chinese-led recovery. Now we're back to, as I said, in the mid-30s. We still like Russia, just not as much of a steal anymore. One country that we focused more attention on recently has been Poland, and specifically the mid and small cap space in Poland. We think that that's been undervalued kind of undeservedly because the market lumped all Central European countries together, but Poland actually had another positive print on GDP in Q2, and this was fairly surprising in the European space. The economy's done phenomenally well given the recession around it. The household consumption has done well as well. So we think there's some good opportunities to be had there.
How much more robust do you expect these emerging market economic recoveries to be versus the U.S.?
Well, I think from a potential point of view, we think that those economies can easily run at 5–6% a year for a number of years starting next year if the recovery continues as it has. So compared to, depending on who you ask in terms of the economists, here you're looking at 2.5–3% potential growth. They can easily run at double that rate.
And you're interested in buying emerging market debt as well?
The emerging market debt is actually more a question of the fixed income side of our shop, but we certainly have been interested in emerging market debt as well. If compared to other opportunities that fixed income investors have on the corporate side, investment grade and non-investment grade, we think it also carries some significant opportunities, especially because you're really getting paid to take on sovereign risk as opposed to credit risk.
All right, we'll have to leave it there. Thank you so much, Vlad Milev with Metzler Payden, talking opportunity in emerging markets.